All right, Edison, let's move on now. Looks like a different type of question here. It says, Mike, a lot of times the theta decay per day of an option does not add up to its current value based on the number of days left. It also seems like it has intrinsic value. Any insight? Thanks. Yes. Just like you've heard me talk about before. Hold on one second. Let me pause the screen here. All right, so the time decay curve. Now, you've heard me talk about this in relation to the married put positions where if I'm 120 days out in time, that those first few months to 90 days to 60 days, I see a slower decay, and then we start getting more rapid, 45 to 30, and then 30 to 0, and the last 15 days is extreme decay. This is the same exact thing you see with a short-term option, whether it's 10 days out, 5 days out, 30 days out. If I have a 5-day out option with a price of $1, you'd say, oh, that's going to be 20 cents per day. No, it's not. It's going to follow this curve where this is 1 day, 2 day, 3 day, 4 day, and on the 5th day, you see the most rapid start to decay. At the open, an option that's at the money that's expiring that day is still probably worth 50 to 60 cents. You still got half of the value you sold it for earlier in the week. That's going to go off in the last few hours. It's the same exact curve. The theta decay, as you're seeing here, for a longer-term option that's 4 or 5 months out, is nonlinear. You can't just take the time value and divide it by X. It is based on that algorithm that shows that you're going to have a slow time decay on day 1, day 2, assuming everything stays the same on your position. I sold a call that expired today, let's say, on Monday. 5 days to expiration technically. I got $1, so I'm expecting 20 cents a day. No. I might have seen 4 cents, assuming everything stayed the same. Now, Edison, the stock price stayed the same, and the volatility stayed the same, which we know is going to fluctuate. But assuming everything stayed the same, I might see 4 cents here, maybe 12 to 15 cents on the second day, maybe 35 cents here. So where does that put me? Well, it's 20 cents, 55 cents. I still have 45 cents left. And that's going to happen at the end. About half the premium is going to come out in that last day and a half. The same time decay curve for long options occurs for shorter term options. It's not linear. Okay, that's what it means. It's that decay line that you expect to see, the decay line of sort of like a radioactive element going to 0. A lot of it happens rapidly right at the end. Same type of algorithm that you see with a shorter term option 1 week or 2 weeks out as well. It's going to retain a lot of that time premium in that position until the last few moments as well. Okay? All right. Let's see here. Okay, all right. That's a tough question to answer. Andras said, is selling premium on the last day smart? That kind of relates to what we were talking about. I'm doing it pretty consistently. While the risk reward is awful looking, it works on 90% of the time. Okay, well, there's 2 schools of thought on that. I'm not a day trader. I never will be. And I consider this day trading. I'm not a short-term trader with 1 or 2 days, Andras. I personally never will be. Just because I'm meeting my goals and have my success rate with what I've been doing. I'm not saying it's a bad idea, but you know what I did this morning? At about, well, once the market opened at 9:30, I had to adjust a covered call position that was wrong in a customer's account. It was rolled incorrectly, so I had to go in his portfolio, delete the previous transactions, balance out the money, and then put in 2 separate covered calls at 100 strikes with different strike prices and different expirations instead of 200 with the same strike, which was incorrect. Then I had a 10 o'clock session, an 11 o'clock coaching session, a 12 o'clock coaching session, had to clean up one of the other videos to post up on YouTube, had to close my trades before 3 o'clock for the Fusion subscribers and make the adjustments I needed to do. I have absolutely no time to pay attention to this, Andras. That's all I'm saying. Is it a good idea on a one-day trade? I had a similar question to this 3 weeks ago, and it was based on a 2-day trade. And the only way I can really answer it, and is you've had a 90% success rate, and I can't fault that. You're probably watching the positions extraordinarily closely because those other 10% that are moving against you, what can they do? They could quickly become losses that could outpace any gains that you've made in the past couple of weeks, the past couple of cycles as well. So, okay, let me go back to quotes here on SPY, and let me do this. So a gentleman was asking me roughly about how this goes. It says, is this a good idea? This is a 3-month chart, okay? And let's go to a 2-month if I can. Okay? All right, 2-month chart. So where are we? We're Friday the 17th. Oh, I got to remove these lower indicators. Just ignore me for 1 second. Oh, I can't remove the MACD yet. I thought I could. That's okay. Let's draw the chart. Excuse me. Okay. So I don't know which direction you're taking, but today was a flat day, a flat Friday. The 10th, not so flat. Kind of had a movement. And I know you're not just trading SPY. You might be, but what I'm trying to show you is, let's go back now to July 3rd, which I believe was here. And it's kind of down a little bit. But you see, there are certain Fridays here where there's a lot more movement. I don't know how long you've been doing this, and I hope this wasn't a Friday, right, that the open. Oh, I'm sorry, you did it at the open, but it still continued down. Maybe you don't do it at that point. So that's what I'm kind of saying in this case is it a smart idea? You've had success recently. I don't know what recently is, but for the past 3 weeks, we've had just a good normal trend. Prior to that, we see some ifs, ands, or buts. And then remember, this is only 2 months. Going back 4 or 5 months into March, end of February, beginning of April, when things started doing this, are you taking a personal direction? Are you making sure that it's bullish, or that you're looking at the futures and you're expecting a bullish move before you do it? And what are you selling? Are you selling a put if you think it's bullish and selling a call if you think it's bearish? Are you doing some combination as well? And then again, you know, what in that case? And David says, what about selling the last day and buying next week out? I don't know. Number one, I'm never going to do this. Personally, I don't have the time, and I don't have the interest. I hit my goals with what I do, and I don't know if it's worth it for me. Andras, if it's working for you, that's great, but what is the risk? If you hit a Friday that's this. We had a trading day a few days ago? Was it last week? I can't remember. I'm sorry. Everything was looking good during the day, and then in the last hour, just jumped. You got to get out of it quick, because remember, you're only collecting 5 or 6 cents at best, maybe 10. All right? So you got to be very careful. So David, you say, what about selling last day and buying the week out calendar to protect it? Well, are you closing both legs? Because you may lose more in time decay in that one day on that next week out long call than you're making on the short term that you're selling. I would have to look at it. I mean, that takes a lot of testing to even kind of consider. But that's a possibility, David, that you're going to lose more time value on the long on that one day that expires next week than you're going to get by selling the option that only has 5 hours left to go. Even though, yes, we just talked about how that decay could happen, we're still going to have a good value on it. But if I opened a position this morning for only 10 or 15 cents, and I bought a same strike call 1 week out, I might get the decay of 10 cents on my near-term call, but I might have lost 12 or 15 on the long. That's a possibility, because it might have cost me $1, not 10 cents. And I might have lost that first 8, 9, 10 cents just on today's trading, depending what the stock did, especially if the stock pulled back. And that's why my call expired worthless that I got 10 cents for. I think it's a risky play. I think it's a risky play based on what we've been talking about, but the one thing I can't say is that, is it truly a risky play? Because that's going to take extensive testing for me to get any kind of idea about, okay? So going back to the main question, though, is it a good idea? Well, you've been doing well with a 90% success rate. I would make myself aware. I would go back every Friday on SPY and NDX, SPY, QQQ, IWM, look at the broad-based ETFs and see what the market changes were, and see if you can look at, you know, the actual time frame. You can here on big charts. I can go to a custom date, a custom, and just look at, you know, a Thursday and a Friday, or a Thursday, Friday, and Monday, and then say, show me every 15 minutes, right? That the frequency, I could go into 15 minutes or 5 minutes, so you can see how the market reacted during the day, to see how many Fridays over the last 8, 12, 15 Fridays had wild swings in a different direction after the market had opened. Okay, there's always some activity at the end of the day. Maybe you're trying to close before 3 o'clock, I don't know. But again, that's where a lot of people might get stuck. I don't mess around with this 1 and 2 day trades. I know it can be profitable. Sam does this a lot, somewhat, I should say, with his account when he sees a good trend that he's been looking for, hitting support or hitting resistance and moving off of it to sell premiums. He mentions his trades to us here. It's not something I do personally, but I can't fault 90% success rate provided that other 10% are outweighing this, okay? I'm not saying that the one-day out trades Andras are doing are wrong. I'm saying I don't have the time to do them. I'm not saying that David's idea necessarily of selling a call this morning and buying a call same strike or maybe a subtly different strike as a calendar for next week is a bad idea. Just based on my knowledge, I'm worried that you might still see more decay on that option further out than what you're going to see in the decay in the option near term. It requires a different look. It requires more research and analyzing into, but right away it doesn't seem to me that that would be a great approach long term, because there are going to be Fridays where the market starts off one direction and then drastically changes direction midday based on some news that comes out, and those losses could quickly wipe out what you've made in the past 4 or 5 Fridays, because you're talking about trying to profit 10, 15, 20 cents at a clip. Take a 2-point loss, you've wiped out 10 previous weeks of trades. And that's my concern with these shorter term ideas, one-day trades. Now, I just mentioned a 90% success rate. I don't see that with my bull puts. That's phenomenal, a 90% success rate. But again, if one loss happens, how big is the loss, and how can we go from there, okay? David says, when do you open the bull put spreads? Mondays? Yes, that's correct. I usually look to open my bull put spreads on Monday, mid-morning to early afternoon, after everything else has calmed down a little bit, right? All the activity, that whatever news came out over the weekend and so forth is there, okay? Oh, yeah. So, of course, naturally, what I said earlier, Sam is commenting on in Apple, I'll not do the trade that he's talking about, the 3-day out bull puts. I'll not do the trade in earnings going to pass for that week. Absolutely. Not the structure to use. Bull puts, directional spreads, not the structure to use, okay? Okay. Oh, tough one, Andras. He says, when or if VIX rises to 50 and the MA crosses over the price of QQQ, would a 3 to 4 month out straddle be a good investment for the mother of all drops? Straddle or strangle, depending on the price. That's where it becomes tricky, Andras. Depending on the price. Sam always makes a comment that back in 2008, you think of the time with the market crash in 2008, when people started buying puts speculating more of a decline, they actually lost money because they bought in when the volatility was too high and the puts were too expensive. And even though the market turned, when that massive volatility collapse, we're talking about from 75 back down to 27. Think about it. That took 2 months, a month and a half to do in this last cycle. Actually, I think we saw the VIX hit 80 in the near towards the end of March. And then by the end of April, I think it was down to 50 again, 45. And then the next month, it was back down below 30. And here we are at, what, 27, 26 today? No, it's popped the other day. That's right. It wasn't that low. Okay, so we're at 26, 25, 68. That's right. Okay, but it's been all over the map. So when the VIX is that high, the puts might be extraordinarily expensive, and the calls might be expensive too. Now we can go back, and I'll probably have to look at this too. So let me jot this down. I've got William with new weekly bull put test for some extended months. Let's see how it did. Let's say how it did just in 2020 so far. Well, that's what I'll run that comparison on. And then for Andras, I want to see what would have happened to a straddle or strangle 3 months out, QQQ, IWM, open at peak of VIX. Okay? So I'll take a look at that historically. I'll see where that is, and I'll get that, or maybe even include that when I start cropping out these positions.